Good morning, ladies and gentlemen. Well, by my calculations, the risk dial is about 32. We've had some very significant developments this week, so let's go through what Powell said and what the yield curve reaction was to try to understand what might happen next week, and especially if CPI is out of line to all asset classes. To best see what he actually said and what the market reaction was, you have to look at the euro dollars and the Fed funds, the very short end. Now, what did he say? He said that he sees very little progress in fighting inflation or for unemployment to go higher, i.e. the economy to weaken significantly, and that therefore it might be prudent to hike the expectations of the terminal rate upwards while getting there via a slower glide path. I don't know in what universe that makes sense. That is like saying we have a fire, we're going to send more firemen, but we're going to send them there slower. Well, by the time they get there, the house might have burnt down. So I really don't understand in what universe that makes any sense. What does make sense is that there are factions within the Fed, and that the Doves placed the article in the Wall Street Journal, and that there was a fight, and that to unite the wings, they had to come up with this kind of compromise. Compromises is something that the bond market doesn't like, because it means that no one is really driving this ship. This ship is now rudderless, I feel. So let's have a look at how the market reacted. This is EDZ22 that you can see, and this is where we were when he started speaking. So we are, 2 basis points higher in price, lower in yield in the very, very short end, which in a way makes sense because he said that his glide path is probably going to be 50 basis points in December as opposed to 75 basis points in December. Let's have a look at M23. This is where he started speaking, and this is where we are now. So we are about 10 basis points lower. Let's have a look at H24. This is where he started speaking, and this is where we are. So we are 14 basis points lower. The market basically is steepening the yield curve at the very, very short end. That does make sense, with the information that we have been given by him. But it really does not make any sense, because I don't think that whether we get to a higher terminal, i.e. let's call it 5% for the sake of argument, I don't think the economy is really going to give a damn whether we get there in 3 months or 4 months. It's really not going to make any difference to earnings. It's not going to make any difference to expectations. If anything, it's going to make people even more cautious. And therefore, these longer tenures start becoming a bargain, in my view, because the odds of the economy not falling into recession, I think, have gone down, not up. So we will see, but I think now that my head and my heart are coming together, and that at some stage we have a real steepening of the yield curve. So let's have a look at how the individual tenures reacted. This is a 2-year note, and it's a daily chart, as you can see. We'll switch this between daily and monthly. This spike here never happened. It's just a bad print. We are very much still at the upper end of the Bollinger Bands and well above the center line, indicating that all the pressure is still up towards 499. If we change that to the 5s, we will see that basically we are neutral, which is the way we should be. If we look at the 10s, we are very much close to 428, and I think that that is going to be resistance all the way into CPI without any problem at all. I think if you see 428 before CPI, it's an easy trade back down. And if you look at the 30s, you will see that they are the ones now that are under pressure. So how did the yield curve react? Well, let's have a look at the 2s, 10s first. This, of course, never happened. Bad print. We got the highest that I saw, it was about 68, 69, 70, and it's coming back down to where it came from. In fact, it closed the week just slightly lower than it was when Powell started speaking. To me, the pressure is now going to be on the downside, and especially if you have a look at the 5s, 30s. They can't sustain and stay at this very important 12 level. They closed on the lows. To me, the odds are that we go and test these levels around 2 and eventually get down to 18. Why would that be? Well, as I said, the glide path is slower, which means, you know, it's disingenuous to say that the terminal rate is going to be higher. It could well be higher, but the odds of the economy being able to sustain that higher level of terminal rate are not that great. In fact, I think they're going down all the time. In which case, the odds of the very short end being able to sustain much higher yields is nowhere near as good as the odds of the 30-year staying elevated, because inflation is just not going to be fought as fiercely as and as quickly as the market thought it might be. To me, the odds are that therefore we actually get the 30s being sold, people not believing the Fed, and this might be a cardinal error so it's a compromise. It's an obvious compromise between various wings inside the Fed, and the long end never likes that. To me, the danger is all on the downside. If it's still below 12 on Thursday when the CPI comes out, the odds are that we go all the way down towards this minus 18 level. That to me is becoming the real danger, that the yield curve steepens, and that is very bad for assets. I'm going to start looking at the 2s, 5s much more carefully now. This is a daily chart. You haven't had this spike, never happened. We got to about here. On a monthly chart, it's actually very telling. We are basically higher than we have ever been, kind of thing. We can go back to whatever this is, 1987 or something like that, 1989. So we are more inverted in the 2s, 5s than we have ever been. Let's take it back to a daily chart. Why would the 2s, 5s be important now? Let me try to explain to you. Whenever the market feels that we are at an inflection point in the economy and the economy is just about to give way, then a disinversion of 2s, 5s or even 2s, 3s is the first thing you look at. This is 2s, 5s. We'll have a look at 2s, 3s in a second. I'm not saying this is going to happen at any time imminently. But what I'm saying is that if we now start slowly falling below these important levels of around 23 and then start making new lows and taking out this level of 12, well, where I'll put another line, that is going to show you the timing that the bond market is telling you that there is an imminent danger to the economy. If we have a look at 2s, 3s, it's actually, very, very significant that we are not taking out these higher levels. And basically, the day that we close below here, I think that is an indication that we are disinverting. And disinversion only takes place for one reason, i.e. the market is telling you timing, something is very, very wrong. There is a big problem going on. Inversion is not a timing for what the economy is going to do. Disinversion is a timing. So, I'm now watching 2s, 3s, I'm watching 2s, 5s, and I think the trend in 5s, 30s is every time it spikes up, you look to sell them, to look for these levels around, 20, 25, something like that. I think that is far more likely than we go up, because I think it's far more likely that the Fed never gets to the terminal rate it's now designing, but that it has to firefight the other way, i.e. the economy all of a sudden gives in. Last week really was quite uneventful for the German market and the German yield curve. The pressure on rates remains. They are so far behind that the pressure remains. There is absolutely no reason to buy it. These are the 2s, and on a daily basis, and if we look on the monthly basis, we can see where the real resistance is, and that's around 268. I mean, I have no doubt that we will get there at some stage. Let's go back to the dailies. If we go to the bubble, still in an uptrend. Still, I have no doubt that we get to 245 at some stage. And the 10s really, going sideways, doing nothing. This is a very, very good indicator. I don't intend to be long of anything in Europe until the 10-year OAT breaks 247. When it breaks 247, it'll probably be, if it breaks 247, it'll probably be a head and shoulders, and you get a much lower target, something around here, 174. I have no idea why that would happen at the moment. In fact, I don't think it will for quite a long time, and therefore I'm still looking for higher levels in everything there. And let's have a look at the monthly chart, because nothing else really gives you an idea where we can go. We can certainly go to here. These levels were traded a lot, or even here. So 335, 325, 335, these levels make a lot of sense. In fact, I'm going to put a line in there. Horizontal, there we go. These kinds of levels make absolute sense to me. 313, the highs, makes perfect sense. If we have a look at what the yield curve did, 2s, 10s, it's looking to break, isn't it? That's a monthly chart. It's looking to break the higher levels, and even if we have a look at what the 30s did, That's the chart to me that says that we are going to get to something like 277 on the 30s. All the pressure is still on the upside of the yields, and I don't think that that is going to change for a moment. That actually gives me the one that I've been most bearish on, and I said 296 is a excellent risk reward. Sorry, 196 excellent risk reward. It got to 196 and it's now 186. To me, slowly this is going to start turning. I think the market has anticipated a collapse in the European economy far more than it has anticipated a collapse in the US economy. And I think over time, and as I've said, this is going to take time now, several weeks, but I think the trend is going to be back down in the differential between Germany and the US. Even if we look at something like twos, they keep on coming back to this 255 level and not being able to break this 255 level and stay above it. I am waiting for this to turn. As you can see, it's still in an uptrend, but when that turns, I think it goes back down to these levels, to around 220 and even fives. This is, if we ever look at actually at a monthly chart of the fives, you can see how we're now going back all the way to 1988. It's very good risk reward on a longer term basis to believe that this will eventually end down here. So almost a zero differential between the two. It's going to take some time, but I'm quite sure that the timing is not years away. I think it's now probably months away. As soon as the US yield curve starts doing what I think, and I told you that it's going to do, I think these differentials are going to start coming in at a rate of knots. Let's be patient, let's watch them turn technically, and that'll be the timing. The US dollar, which has been a wrecking ball all year, I think is it's in the process of turning. How would I put this? Well, you've had a belief that the war in Ukraine is going to really hit Europe very, very hard and hit the US much less. I think that view might be reversing. The dollar hasn't really been responding to interest rates, as you saw from the chart of the differential of the 10s in Europe and the States. It hasn't been responding to interest rate differentials all year. So it's completely consistent to think that the interest rate differentials will come in and also the dollar will weaken. I think this line now, 109.29, becomes the line in the sand. Below there, you could get an acceleration of the dollar weakness all the way to around that 106 something level. It's going to take some time, but I think it's more obvious that it's going to happen, and I think that is why gold responded, precious metals responded the way they did. I think that we are on the cusp of a weakening in the US dollar. How far is it going to go? I have no idea, but what I think that what is more likely than not is that we accelerate into a test of these upper levels of around 102 something to 103 something, 104. over the course of the next 3 or 4 weeks. This to me is far more likely than we continue on the down path. We're beginning to make higher lows, and that to me says that the danger is that we go to at least this 102 something level. Let's call it, what are these levels? 102.50-ish, where we start fighting the rapidly descending 200-day moving average. That to me is far more likely. I think it's you know, when you say, as the Fed has said, that you're going to go to a higher terminal, but you're going to get there slower, the slower the market gets, the I'm going to get to a higher terminal, well, maybe you will, maybe you won't. It depends on the economy, doesn't it? So I think that the odds that we do a higher high here towards these levels are beginning to be overwhelming. It's not something that's going to happen in the next 2 or 3 days, or maybe not even in the next week. But I think that by year end, this kind of level is more likely than not. Gold and precious metals in general were the surprise on Friday for sure. And the only way that I can explain it is with the narrative that the market is beginning to doubt the higher terminal, and all it's hearing is the slower glide path. It makes sense. If you are uncertain that the Fed is really all that committed, or it will really stomp on inflation, then you buy gold. And, basically all we did is we rejected these levels below 1658. We might very easily just faff around for a few days and then break higher to the 1764 level. Technically, that is what a retest from the underside of the 200-week moving average, which is still going up. And look at all these weekly moving averages way up here in the 1800s. So that, could that be easily achieved? Yes. I think 1764 is going to be the level that we, go and test over the course of the next couple of weeks. Certainly not before CPI, I don't think. But that is something that could easily be achieved. The big question here is, do we go higher than 97.77? I have no idea, but I think we test it next week. And basically that will coincide with a test of the underneath of the 200-day moving average in oil. Where is it? Here it is, 97.40, something like that. So that could easily happen early next week, and then we decide which way we go. It's matching up with gold going up into the 1700s. And if we look at DBC, it matches with 26.93. I think next week we see 26.93, a few stops above, and then we see if we close above it or close below it the week, and that will give us the trend. The strength in copper was noticeable, right, last week. And if we enlarge this, this is a daily chart. I think we take out this 374 level and go and test the underside of the 200-day moving average. Basically, it's the same pattern in gold, it's the same pattern in DBC, it's the same pattern in copper. we go and test that underneath and see what happens. Now, this copper gold, I think it's coming back to 158, and actually at 158 the odds are that you go the other way, that you buy gold and you sell copper. And that's something that I have my alert enabled, and at that level, oops, what have I done? 158. Well, let's call it 156. What's the difference? And that level, I think the odds are that we go back up. Now, these are very interesting junctures. This is TLT over GLD on a monthly chart, and we are basically at the lows that we were in 2011. We are, oversold, but what this is telling me is that certainly TLT is in trouble. Unless gold starts going up huge, TLT is in trouble. And let's face it, why would we be on the lows of a decade in the relationship between TLT and gold? It can only be that people are doubting TLT. And that is very, very dangerous. It seems to me that the yield curve at some stage will have to steepen considerably. And basically the market, it's saying that it's doubting the Fed. I mean, this is a sign. This chart is the ultimate sign that says the market is now doubting the Fed. If you have a look at SPY over GLD, and this is a monthly, this is not looking great, right? I mean, it's saying that we are going to go back down towards these levels and the lows of the year kind of thing. And it says that both TLT and SPY are far more in trouble than gold. So it's not really that gold is that much of a fantastic asset. It's just that it's, the cleanest shirt in a very dirty laundry basket. The only way that you can make sense of these spreads when you have TLT yielding you, let's call it 4.5%, and you have gold yielding you nothing, and still TLT is getting sold against gold, that can only mean that in real terms, people don't think inflation is going to fall. You're going for a real zero return versus still what is a negative return for TLT in real terms. And people still don't believe that we are anywhere near the bottom. If I was the Fed chairman, this chart would worry me, because it's speaking very loudly. People just don't believe me. If people believe me, they would be buying long-term bonds, and they certainly wouldn't be buying gold, not on a ratio of one against the other. So something very, very big is going to happen soon, because this is just unsustainable. If people don't believe the Fed, we are in for a world of hurt in TLT. In the fight between the asset classes, the one at the center of the butterfly between gold and bonds seems to be the equities, because the indices are composed of many different types of equities. So what they're doing is basically holding the time 16 line and basically going a little bit above, a little bit below. The fact that it's trending down tells you that every time it's above it, it's a sell, and every time it touches the low, it's a buy. But basically, we are stuck at the moment in equities, I believe. I think every time it gets squeezed to the 38.50s or something like that, there will be sellers, and every time it's anywhere near the 36.50s, it's going to be bought. That's what this chart says, certainly for the time being, and I certainly don't expect us to be very far away from where we closed on Friday by the time CPI hits. And then we will probably get a big move led by bonds. Let's have a look in detail where we will the levels in SPX and NDX. But before we look at the individual indices, I mean, this is quite obvious. This is NDQ over SPY. This is a monthly chart, and the monthly trend seems to be quite obvious, even if this is only an ABC, and even if this is just a trend, reversal to the trend. You're looking for this kind of level. You're looking for around 26.52, which is basically where the whole move up in COVID started. So reversal of the whole COVID move. And that tells you that we have another, 10% in it. If we go to NDQ DGI, i.e. the Dow, much the same kind of thing. Even if we are returning to the trend, slowly, this is saying, if it's ABC, we're going back to the levels that we were when the whole COVID thing started. It makes sense to me. There are, the higher yields, and we are back to and even higher than the yields that we were before COVID, will continue to affect the longer duration stocks like NQ much more than they affect other stocks, which have far more defensive capabilities to them, and the continuation of this trend down to this kind of level 30, and we're now 34. That's just 10% again. So you are looking for DJI to behave and SPY to an extent to behave much better than NDX. This is an interesting chart, SPY. It's basically showing you the stability after the Fed. I really would not be surprised to see it at, say, 38.23 at some stage before CPI, and then we see. But to me, from 38.23, the odds are that we go quite a bit lower. Certainly back to this 37.25, and then lower. Why? Because it's the monthly chart, stupid, as I keep on telling myself. These moving averages just will not be moved. You're talking about 39.50s and here 38.50s. So that area between 38.50 and 39.50 is very much a short area, and as you can see from the monthly chart, the support is here. This is basically 3,600 down to 35.60. That is your real support. This market just hates closing below and staying below monthly Bollingers. You can see what it does. Every time it does that, it goes straight back up. So I really would not be surprised if we spent the rest of the year in this kind of a range. ready for at some stage this economy to give up, and then we just accelerate downwards. If you compare and contrast a monthly chart of NDX to SPX or DJI, it tells the story. Really, you're talking about a range between something like just short of 12,000 to, over the next couple of months, going round down to 9,700, something like that. It'll be a shock when we break 10,000. It'll be headlines, and then it'll be time to go back up, kind of thing. But this is a much weaker chart. We are opening up the Bollinger Bands much more, and I would have thought at some stage over the course of the first quarter we will touch this 9,000 level, which is really where we came from on a monthly basis in NQ. As you can see, that is my level where I think it's time for long-term call spreads for at least a 30% move upwards from. But I think that we are going to get there, and that is what that chart is saying. If we have a look at what it's saying for the shorter term, I think it's going to remain in a range. That's why I'm not immediately bearish of SPX. Really, you're looking for these 11,276 level to be the high, and with a weaker dollar, we could easily get that kind of level before it gives up again. That is what you're looking for. You're looking for relative stability and screwing everyone on the upside and the downside. I don't think the US is ready to go down immediately. I think it's going to take a few days or even weeks of sideways before it gives up. But I certainly think that anything during this Santa period is going to be of very good seasonality, is going to be a very, very good time to start thinking about building longer term short positions. And the reason why I don't think we are immediately bearish is because the transports and the Dow Jones Industrial are really not showing any signs of breaking down or being in a position to break down immediately. I think it's far more likely that they stop people out and try to get to 33,015. That, to me, is a good risk-reward point for the Dow to be short. And I really would not be surprised if we took some stops out in the transports as well on Monday and Tuesday and Wednesday, and that will be the opportunity to go against it. So, I think we are in a range in SPX with anything in the mid 3800s as a very good sell, and if we see 33,015, it's a great sell in DJI. This spread is also talking. This is SPY over FEZ. So basically, in dollar terms, the US against Europe. And really, we are not much higher than the levels when all this started in Ukraine. Where is it? It's here, right? February 24th was here, right? And we're really not that much higher. So basically what we're doing is we're taking out the whole of this Ukraine thing, and we're saying that Europe and the States are much in much of a muchness of a state, which makes sense. I think the market was far too bearish on Europe and bullish on the US, and now, as I told you, I can't remember what was it, a week ago or 2 weeks ago that I drew your attention to this. And this actually tells me that the dollar is going to get weaker. And if the dollar gets weaker, it's not immediately bearish for SPY. And yes, we could have a few days of retracement here, but eventually I think we're going to go back down to these levels. And I'll even put in a line in here. This kind of level to me is going to be where this trend stops and we get a bounce and reversal. So at the moment, this favors European stocks over US stocks, and it favors most probably a weaker dollar. So let's have a look at a level that Europe can get to and squeeze the US with it and then give up. To me, that level is 37.61. I've already placed orders. I don't want to even think about it. To me, 37.61 is a great level to start shorting either Europe or all equities in general. And the fact that we closed on the highs of the week, really, taking out everything that that Powell did to the market, indicates to me that we squeeze out all the shorts in SPY as well. And Europe gets to this 37.61, and then it starts giving up. And as it gives up, then the states give up as well. To me, that is far more likely than not. And the final argument I would give you why the state is not going to collapse immediately, and there's no point in being too bearish on the US, is actually the VIX chart, which always retraces the gaps. And we have a gap down here at 22.79 and another gap here down at 20.60. For the, it's incredible how I'll enlarge this weekly chart, and we are now down, and all we need to come down to, is to this 200 period moving average on the weekly to fill all those gaps. And here it is, the gap is down here at 20.88, and fill this gap, and that should take SPX into the 3800s, 3900s, or 3850, 3900, something like that, basically where we were, where Powell started speaking. And to me, that makes sense, that it's going to take several weeks to turn the US. And in the meantime, we fill this gap, and then we're probably ready to go much higher in Q1, when the US economy can, basically turn over and go down. And that really fits in with the argument of when the yield curve is going to disinvert. It's not going to be, as I told you earlier, it's not something immediate. But what I'm looking at is the 2s, 3s and the 2s, 5s to start to give me the timing. Because when the 2s, 3s and the 2s, 5s disinvert, the timing cannot be very far away. I've updated all the levels, and I don't think I'm going to be ready to do very much before CPI. All I'll be watching is the yield curve at the short end, as I've mentioned. The real danger now is one of steepening, and steepening in a major way. I don't think it's going to be happen in the short term, so I'll just be watching. And there's really not much else to be said, because if CPI is bad, the reaction in bonds, especially the long end, I think is going to be very, very violent. So we'll wait for that, and we'll see what we can do. But the positions that I have, I think are basically exhausted, and I will be looking for opportunities on Monday to basically close everything down and be ready to initiate something completely different over the course of the next weeks. Thank you very much indeed, and tweet you tomorrow.